There are fathers that literally go to the library to pretend they're working. We've created a whole new world of higher interest rates, higher inflation, and higher bond yields. That is what's triggering this colossal.
Larry McDonald is the former vice president at Lehman Brothers and one of Wall Street's most insightful risk analysts who predicted the 2008 financial crisis. As a best-selling author and frequent voice on CNBC, Bloomberg, and Fox Business, Larry now advises top hedge funds and investors on navigating global market risk and political policy shifts.
When you go from 51% market share passive versus active to 52, 53, 54, 55, it becomes more and more evil because...
You feel that we've entered a period of secular stagnation. What do you feel causes that?
Well, many of you have asked what books I'm reading. Well, today is going to be a special treat as I'm going to be interviewing the author of my favorite book for 2025. In fact, I bought copies for my entire staff, insisted on them reading it. Joining me on the program is Larry McDonald. He's a political risk expert and founder of the Bear Trap Report. Known for predicting the subprime crisis, he's also a former Lehman Brothers vice president. He regularly appears on CNBC, Bloomberg, and Fox Business. And the name of his book is When the Markets Speak. Larry, I want to start our conversation with something that everybody that has read this book has noticed, this paragraph that kind of sets the stage of what is happening. And this was after the 2022, which there was a $9 trillion loss of wealth in technology stocks and crypto. And I want to read this. This offers just a taste of what's to come and marks the very beginning of a seismic shift in the performance of financial assets. The economic world as we know it and the rules that govern it are over. In the coming decade, we'll witness a new era of persistent inflation, an escalation in the global conflict, a multipolar world teaming up against the United States, the horror of a weakening dollar, a series of sovereign debt crises, and a thundering of capital out of financial assets into hard assets. The entire planet is soon to experience catastrophic shortages of natural resources, and imagine a world that is constantly short of energy supplies. You're talking about, just in that paragraph alone, a major paradigm shift geopolitically, economically, and financially as we're in the middle of this fourth turning. Let's begin with that. Well, I'd like to ask you, what caused you to put this all into a book? Because very prescient when you wrote this in terms of what's unfolding this very day.
Well, thanks so much for having me, and it's very touching that you were so thoughtful to buy the books for your staff, and it really means a lot to me and the team. I mean, the book, the key to this, my first book was a New York Times bestseller about Lehman Brothers, and I was a trader there. We wrote this story, and it was very romantic, and it was very high drama, because I worked my way all the way up to get into the velvet circle in Lehman, and then you realize Lehman Brothers became a big bank failure, and it had a lot of drama, and it was a great book, and it's been published in 12 languages, a colossal failure of common sense. And over the last 10, 15, 20 years, we've done 140 speeches in 16 countries, and we've met so many talented, beautiful contributors and friends. And so what we do behind me is we run a Bloomberg chat. So it's on the Bloomberg terminal. And if you think about it, it's like a live ideas dinner. And so what we've been doing, and this is how we put together, the book, and How to Listen When Markets Speak, is we are gathering the intelligence from some of the most brilliant portfolio managers in the world. I'm kind of the quarterback. And the bottom line is with this story is that when you run that kind of conversation with, say, 600 individuals, and they're in 20 different countries, and they're all veterans in either junk bonds, equities, rates, what you can see is from time to time, you can see trend shifts in narratives. And in 2021, 22, we started to see this in the chat around, wow, this is a big secular change coming at us. And I wanted to write the book to democratize information and get people ready for it. The bottom line is there's no I in team. I owe so much to the entire group that helped me put the book together.
I mean, you have some impressive people. Charlie Munger won, David Tepper, David Einhorn. I mean, it's just a host of just high level people. You know, the collapse of the USR ushered in an era, a unipolar world with U.S. dominance and unprecedented disinflationary power, surging supply of just about every raw material to finished goods. You're talking about that era is gone. The implications of a multipolar world and the ability to stabilize global markets.
Well, what's happened is there's a couple evil things have gone on. Jack Bogle and passive investing and the indexes, he meant well, and it was a brilliant idea at the time. But what happens is when the money, and think of active management means someone's running the portfolio. They're choosing stocks to buy, stocks to sell stocks to hold. That's a human being. Um, a passive fund is an index that is simply the largest companies have the highest weight. And so when you go from 51% market share passive versus active to 52, 53, 54, 55, it becomes more and more evil because the what we call the mechanism in the market, the reaction function stops working. In other words, there's so much money in passive, and everybody's making money as the stock market goes up. When you have a big secular change that's coming at the market, the reaction function's more slow. The bigger passive gets, right. And all that means is the indexes, it's like turning around an aircraft carrier, and it's happening, trust me. But what we're trying to say in the book is everybody's massively long what we call financial assets. So that's bonds, growth stocks. Everyone's 401ks in the same trade. And that's because it's worked. And that's because when you go to the golf club or you go to the bowling alley or talk to your friends, they're all making money in the same stocks. And so this trade's gotten bigger and bigger and bigger and bigger. But meanwhile, under the surface or just, in front of us, the entire landscape has changed. We're in a multipolar world now. We're in a higher interest rate regime. We're in a much higher inflation regime. And what that's going to trigger and what it's starting to trigger is this huge migration of assets from financial assets to more hard assets. And all that means is companies that own things in the ground, whether it be phosphates or whether it be natural gas or oil or copper, gold. And so those groups have become have been reduced to such a tiny, tiny, tiny portion of the market that we're going to see a massive secular change where the market rotates. And when, like I said before, that reaction function is more slow today because of passive versus active, but it's clearly in the works. The migration is clear. We're already right now, the NASDAQ 100 in February was worth 27 trillion, and we hit about 23 trillion recently. So we've already seen about a $4 trillion migration.
China's entry into the World Trade Organization accelerated offshoring, resulting in the next 2 decades. I think we lost about close to 4 million jobs. The role of offshoring, explain what that played in deflation. Recycled trade surplus, key reason why rates remained artificially low. And one of the issues that we're seeing in this market now as we try to reshore, we're talking about tariffs. Money has been exiting the U.S., and a lot of that money supported our bond market and stock market.
Yeah, we went through a 15-year period where disinflation became more and more and more certain every year. And what that does is when disinflation, all that means is a tendency toward deflation, disinflation. That just means that in that kind of world, you want to be in growth stocks. Bonds work really well because they get lower bond yields. The Fed was buying, because there was low inflation, the Fed could buy bonds all the time and suppress interest rates whenever they wanted to kind of jack up asset prices. And so we went through this for a long, long time. But now we've crossed into that multipolar world with higher deficits, really, like you said, reshoring. And that reshoring is a big part of it. And that's part of what we talk about in the book. There's just so many families that have been displaced by kind of the East Coast and West Coast elites, what we call in the book, where, if you're in Washington, New York, or Los Angeles, or San Francisco, you did great the last 20 years. But if you're in the middle of the country or in the Rust Belt, there are fathers, and we did so much research in this book. There are fathers that literally go to the library to pretend they're working. Um, they're working in an Uber driver, someone that used to work at a factory making $140,000 a year. And so the good news is we've raised the standard of living globally. If you're in Bangladesh or India, the average 20-year-old, 25-year-old's making probably doubled his income over the last 10 years. So the beautiful thing is the globalists, the whole Davos crowd, they've done a wonderful thing for the planet. They've raised that standard of living globally, but guess what? They've created far more carbon consumers, right? And
Sure.
so if you're working in a call center in India, you're making probably 40 times more than your great grandparents. And what's the first thing you do in India when you make a little bit more money? You get a moped and maybe you get some air conditioning. And there's 1 billion people in India that don't have air conditioning.
Hmm.
And so with the reshoring and everything that's going on around raising that standard of living globally, we've created a whole new world of higher interest rates, higher inflation, and higher bond yields. And that is what's triggering this colossal migration of capital from financial assets over to more hard asset portfolios.
Yeah, you talk about this east-west just-in-time supply chain. I can remember reading about just-in-time inventory. Uh, Reshoring, friendshoring, backup supply chains are inherently inflationary. Let's talk about as we bring factories back here, what are we going to need? We're going to need power, we're going to need electricity, we're going to need raw materials, and it's going to be more expensive to produce stuff here than, let's say, when we were offshoring to China.
Right. Now, the counter argument is Trump and that whole team mean well with reshoring, but it's going to take a long time to get. I mean, we're probably never going to manufacture Nike shoes in New York. You know what I mean? Nike sneakers. But are we going to reshore a large percentage of jobs that have left, or a good, 10, 15, 20, 30% of jobs left the United States? Yes, it's going to take a while. But at the same time, we've got this artificial intelligence renaissance where the amount of data centers that are popping up and exploding all over the United States are huge, huge energy consumers, huge electricity consumers. And we think the amount of electricity usage from the data centers and from the reshoring and from a whole bunch of different secular trends will potentially triple our energy consumption at the local level over the next 10, 15 years. And so do we have a kind of a infrastructure, an energy infrastructure to support this right now in the United States? Do we have enough natural gas? Do we have enough nuclear power? Do we have enough copper wires that are going to make up that ecosystem of transformation of power, or just transfer of power through copper? We don't have those resources right now. They're in the ground, they're up in Canada, in under the ground. And so we're literally spending all this money on capex for artificial intelligence on the technology side. These companies are spending $1 trillion, whether it be your Metas, your Googles, your Apples, $1 trillion of capital expenditures. And guess what? We don't have the infrastructure to support all of those data centers, all of that artificial intelligence.
I want to talk about something that happened in the late 90s, and that is the Fed bailout of long-term capital management. You have a chapter called Crossing the Rubicon. When the Fed did that, they set the stage for bailouts to come, and we've seen that successively with each new problem in the markets. The Fed comes in, injects liquidity, but talk about the problem that this creates in terms of risk. It tells me that, hey, if I want to go ahead and speculate and I'm big enough, I can go ahead and do that because they got my back if I go under.
Right, exactly. They've conditioned markets going back 30 years over and over and over again, whether it be long-term capital, the S&L crisis, Lehman Brothers. Just recently, if one of the stats from the book, Jim, I think is so important, is that the fiscal and monetary response to Lehman Brothers, that's fiscal and monetary, so the Fed plus Washington spending, that fiscal and monetary response was $4 trillion.
Mm.
The fiscal and monetary response to COVID, the regional bank crisis of 2023 and the fiscal juicing into the election. You know, you can blame Biden, but a lot of presidents fiscal juice, all that means is massive fiscal spending into the election to prevent a recession. Those three things got you 16 trillion of fiscal and monetary response. So the Lehman response was 4 trillion, and now because of COVID, the regional bank crisis, and that's kind of like what you said, our long-term capital. So the COVID plus regional bank crisis plus the fiscal spending into the election was $16 trillion. And to me, it's certain that the next 10 years, we're going to be on a much higher inflation and bond yield trajectory because they've chosen not to take the pain. And every time they choose not to take the pain, they're just putting more inflationary fire, or I should say kindling and wood into the furnace.
And we saw a little bit of what can happen with this, and this is from your book, whether it's big oil in 1981, tech stocks in 2000, or financials in 2007, when a sector is dominant over an extended period of time, that is where the most significant downside is lurking. And I'm talking about like the Mag 7 and the tech stocks, because we saw that, Larry, in 2022 when money came out of these index funds. And we'll get to index funds later on. When that money came out, the big tech stocks, which were a larger percentage of the index, got hammered. I mean, some of those stocks were down 40 and 50%. So I don't think investors today realize the risk that is out there in passive indexing.
Right. And so let me give you an amazing stat. So 10, 11 years ago today, somewhere in there, the oil stocks are worth a little bit less than $4 trillion. So all the oil stocks in the market were worth about 3.4, 3.5 trillion. And the NASDAQ 100 was worth about 4 trillion. So they're basically the same size, right? NASDAQ 100 versus all the energy stocks, oil and gas. Today, the oil and gas stocks are worth about the same, a little bit less, maybe 3.4, 3.3 trillion dollars, maybe 3.3. And the NASDAQ 100 is worth 23 trillion.
Wow.
And so if you just think of NVIDIA relative to the natural gas ETF, the FCG, Frank Charlie George, that ETF, the largest holding in the FCG, has a enterprise value of $40 billion. You know what I mean? I mean, that's literally a bathroom rounding error over at NVIDIA. So NVIDIA is worth close to $3 trillion, and the entire FCG, and so that's natural gas equities and URNM, which is all of the uranium sector equities. So that's nuclear power, natural gas. Literally, the entire foundation to support artificial intelligence. Those stocks are only worth not about a third of what NVIDIA is worth, and not even a fraction of what's in the tech stocks. So what's amazing is if you believe Jensen and what we call, the big sales pitch from NVIDIA and the big sales pitch from AI, if you believe these guys and you believe Wall Street's growth trajectory that they have for these companies, if you really believe that, then the natural gas equities and the uranium sector, these sectors have to go up 300 to 500% to support that growth trajectory.
You feel that we've entered a period of secular stagnation. What do you feel causes that?
Well, so secular stagnation was kind of the period of say 2010 to 2020, where we had disinflation, we had the Fed constantly doing QE, and we had very slow growth in the economy, right? Secular stagnation. And that's what Larry Summers coined that term, secular stagnation, where it's certain deflation, austerity in Washington, austerity in the UK, austerity in Greece. So this is that 2010 to 2020 regime. We had the Tea Party in the United States. We had a very much more fiscal discipline, just a total different world in terms of certain deflation every year, disinflation. The Fed was doing QE. That's secular stagnation. Now we've moved into a period where the German government, which was literally the pounding the table hallmark foundation of austerity 3-4 years ago, if you went into the German finance ministry, within the last 5 to 10 years, and I'm not sure it's still there. There was a picture of Black Zero,
Hmm.
and that was all about this hardcore regime around austerity. Now the Europeans are like, oh, we have to spend more on defense to support ourselves because the United States is pulling back. And this all goes back to Ferguson's law. So Neil Ferguson was, first of all, he's the best financial historian of all time. He's written a number of great books. Just Harvard, Stanford, incredible background, Neil Ferguson. And his point is what's called the Ferguson's law, where if defense spending is crowded out by interest on the debt, then you have a big secular problem for like that type of country like the United States will fall by the wayside globally. And that's essentially what's happened is that the the defense spending in the United States is now at a lower cost than interest. Interest is now we spend more on interest than on defense. And what that means is we're going to have to really pull back somewhat over the next 10 years on defense. That means other governments around the world are going to have to spend more. And so you have this massive period of fiscal spending globally. And at the same time, we've just done an enormous amount of fiscal deficit spending in the United States. And so you have this regime where everybody's spending on the fiscal side. And there's no austerity in the world. And that gets you that higher interest rate, higher inflation regime.
Something else you talked about, countries have policies to protect their industries. We're talking about tariffs here, and workers against ferocious competition. Wall Street focused on the effect of cheap imports. Companies bought back stock instead of investing. So, how did cheap debt and financing distort that? I mean, I what was it? Almost 13 years we were dealing with 0% interest rates. And nobody talks about the side effects of what this did for savers. I mean, people that were retired, used to get money in treasury bills or CDs, got nothing.
Right. In that certain disinflationary world, Jim, um, the Fed could be much more aggressive around supporting the bond market in times of stress. Every time we had a problem, the Fed was there with QE, and they were trying to create TINA. There is no alternative, TINA, and they were forcing money into all different types of other assets. And so when they did that, they allowed companies to artificially borrow at extremely low rates year in and year out. And those companies in the S&P 500 were able to buy back obscene amounts of stock. I mean, if you just look at the Berkshire Hathaway annual meeting and the amount of stock that Apple's bought back over the last decade, I mean, it's in the hundreds of billions of dollars, right? And so Buffett now knows it's the end. Buffett's taken his Apple position from a billion shares down to 300 million. So he's cut it from a billion shares to 300 million. Buffett's basically getting out of Apple because he knows in a higher interest rate regime, it's going to be much more difficult for companies as a whole to do a lot of these buybacks. So that artificial support for the market through buybacks is going to be curtailed somewhat.
I want to talk about this new consensus in Washington you talk about in your book, in particular, the suppression of volatility, because it gave a false sense of safety and allured investors. Now, I'm thinking of the last decade, Larry, into products or investments that they have no business in. Most people, when they retire, they de-risk their portfolios because they're going to be dependent on what they've saved. But that's not what happened in the last decade. Investors were going into areas of the market, whether it was junk bonds or other areas that were real speculative as a result of these low interest rates.
Right. And it started off with what we call private credit. So that low interest rate regime pushed money into high junk bonds, private credit. And now we've created a big bubble over there. And yeah, so there's a line in the book: when you don't allow the cleansing process of the business cycle to function over longer and longer and longer periods of time, what you do is you just create all of these excesses that become so big that it's very difficult for central banks and governments to actually let markets work, because the excesses are so enormous that if they actually let the markets, if they actually let capitalism work, and if they allow what we call creative destruction, which is the key to capitalism is cleansing out the bad guys, the bad apple, and creative destruction. Right now, we're in a period where, if you just look at the last decade, they're really not allowing any creative destruction. Every time there's a whiff of a recession, they come in with massive fiscal and monetary response, and we just get more and more of a buildup, which creates more and more of a problem. It's starting to unwind. It's going to unwind over the next probably 3 to 5 years. The bottom line is the probability that the highs are in for the S&P, right here for the next 5 to 10 years, I think is extremely high. In other words, we've done everything we can to pump up the S&P through buybacks, through not allowing the business cycle to function, through very aggressive fiscal and monetary support. And so the probability that the S&P peaked in February and that high lasts 5 to 10 years, just like it did from say 1999, 2000 to 2008, 2010, I think it was, when the Nasdaq got back to the highs. That's what we're heading for again.
Yeah, I want to talk about where this is leading to, because with this QE over the last decade, there was a suppression of volatility. I mean, if you look at the VIX, it was down there at the bottom. I want to talk about one of the first Vesuvian eruptions, which was January 2018, Volmageddon. Let's talk about that and how we may see more of that.
Okay, so that was a period exactly of a lot of fiscal and monetary support, a lot of monetary support. And Trump was president, and at the time, inflation was starting to surprise to the upside. And China at the same time was threatening on the tariff deal back then. So we had two surprises. We had a little bit of inflation surprise, and then we had a period where China was threatening in terms of the trade deal. And the VIX exploded because, once again, central bankers had suppressed volatility, suppressed bond yields, and they pushed more and more and more and more investors into what we call volatility selling. And so there were all these what we call volatility control funds. And they were just you had literally billions and billions of dollars of capital that was just in a strategy of just selling volatility, equity market volatility. And every time the VIX went up, they would sell it more and they would double down, triple down. And it worked for a really long time. And then, it really exploded in February, March of 2018. And that was kind of a precursor for what's ahead. And now, think about from August to now, we've had two moves in the VIX. Two, not that many months later, we've had a very similar explosion in volatility. And so that tells us that we're in a whole new, different volatility regime.
One of the things I think I've learned, one of the biggest lessons I've learned in my career is the credit markets, following the credit markets. To me, the bond investors are the smartest guys on the street, and moves in credit markets foreshadow and lead equities. Let's talk about that.
Okay, so credit has been very, very tight. In other words, low yields on junk bonds for a couple of reasons. Number one, bond yields, it's hard to explain, but they suppressed the cost of capital for so long that if you were a high yield manager for a long period of time, you had these tiny coupons. Now interest rates are higher. But what I mean is the spread between treasuries and junk bonds in the last 6 months have been very low, but bond yields are higher. So what's happened is, because interest rates have gone up on the 10-year bond and the 30-year bond, that's raised the interest rates in credit markets. And credit portfolio managers are just, they're like, they thought they died and went to heaven, because for the first time in 15, 20 years, they're able to get incredibly high coupons. Now, the spread, once again, spread between treasuries and junk bonds has been relatively low over the last year, except for recently. But those coupons are high, so that's brought in a lot of buying. But recently, let me give you an example. So the high yield index is now at a level where we were roughly back in August, and the S&P is 10% above August levels. So to me, and if you listen to people in our chat, we talk to the smartest hedge funds in the world, are right behind me, and we're starting to hear real cracks in the private credit scene that are starting to leak over to high yield. It's just a start, but do we have a credit crisis? I think there's a very high probability. And don't forget, a lot of companies, Jim, a lot of companies issued bonds during COVID and they locked in great yields. And the next 12 to 18 months, those bonds are going to roll over at
Hmm.
much higher yields. So the probability that we have a real meaningful credit crisis in the next year is extremely high. You want to raise cash here and you want to, sit in the boat and wait for that real opportunity to get long. That's what Buffett's doing, right? That's what Buffett's doing. His cash position is up from February. I think another 14 billion, Jack, from February.
Yeah,
And
what is it? He's like 350 billion now.
yeah, 350. So he just knows that we are going to come into a real period where that whole passive investing just unwinds. And remember, the oldest boomers, Jack, Jim, the oldest boomers now are about 79 years old. And so 10 years ago, the oldest boomers were 69. And so when you get that 79 trillion of wealth in the boomers, and that's what they have. The boomers have about 79 trillion of wealth, and the oldest boomer is about 79 years of age. The millennials only have about 8 or 9 trillion of wealth. So you have the largest, oldest, wealthiest part of America, all turning, no, the top end of it's turning 80. And that's going to force people out of the market, out of passive and into commodities, um, different types of alternatives, and bonds to some extent that are much higher yields.
In your book, you talk about this change of inflationary environment, which we're in the beginning stages of right now. Inflation is baked into our future, and you say, buckle up. Let's talk about that because we were so used to disinflation for 3 or 4 decades. I mean, bond yields fell for almost 4 decades. That environment is changing. And we're seeing it now with not only treasuries, but in fact, I forgot to mention this. You talk about volatility in the stock market. Let's also talk about the volatility in the bond market with the MOVE index. We've seen some mishaps in the treasury market we're not used to seeing.
Right. A couple of things are going on. So when we talk to European investors, they are just so freaked out because the United States, because of our debt is so high, the United States has started to act like an emerging market country in the sense that we have bonds that are selling off, so higher yields, stocks lower in price, and the dollar lower. So we've had a period here the last month where stocks are down, bond prices are down with higher bond yields, and the dollar's down. And that is the type, Jim, that's the type of thing you see in emerging market countries. It's freaking out global investors. And if you're a pension fund manager in Europe, you've got a gun at your head to take down dollar exposure right now. And and it's not just Trump's fault, it's Trump and Biden. Biden juiced spending by $1 trillion in the first quarter. And so that on his way out, they spent $1 trillion. They jacked up the deficit. So bond investors were already freaked out heading into this tariff game. Trump's playing tough guy on tariffs. That created a situation where people are like, oh, maybe our foreign counterparties aren't going to be there to buy our bonds. And we had this huge stress point in the bond market. At the same time, the basis trade started to blow up, and all that means is it's a very complicated trade where people are playing around with different types of treasuries. And all of that kind of blew up at the same period in early April. And and we started acting like for the first time in probably almost ever, the United States started acting like an emerging market country, and that's really freaked out the global investment community.
I want to move on to the chapter you talked about energy, and we've seen these ESG policies. And I think in your book, you talk about there's about 2.5 trillion needed investment that was foregone. Companies, and you see this with the big oil companies, if they were drilling on Wall Street instead of drilling offshore or in the ground. And you're talking about higher energy prices. I don't see how we cannot see that. We're not making new discoveries. We're not making those investments. And we're talking about population growth. in the rest of the world. We tend to think of what's going on here, but if you look at emerging markets, India, as you mentioned, if you're making more money in India, you buy a scooter, you're going with air conditioning, all of that. This world runs on fossil fuels, and I think we're myopic in thinking that we can get rid of them.
Well, exactly, Jim. What happened in the last decade is it's mind blowing because we went into this Green New Deal regime, and it was almost like Jonestown, where everybody's drinking the Kool-Aid, where people were talking about carbon neutral 2040, 2050. People are talking about taking diesel cars out of Europe by 2025. I mean, the lunacy of these assumptions it was just off the charts. And and now what we're seeing is Washington, all the scientists, they're walking this back. Carbon neutral 2050 is really 2100. And the only way you get to that green meadow, which eventually we're going to get to, eventually solar and wind will be a much larger piece of the pie. But the only way to get there is through investing. But we just went through a period where there's a line in the book where we talked about if you take the 2010 to 2014 capital investment regime in oil and gas and metals and nuclear uranium and all the things that we need to support the planet. That trajectory, if we took it from 2010 to 2014 to today, we're in about a $3 trillion hole relative to the previous path.
Mm.
And that's because of two things. We had a commodity bear market in 2016, and like you said, it forced companies to think about capital retention, capital reinvestment, dividend paying, and less investment. So I'm not going to blame it. You can't blame it all on environmental restraints. But then at the same time, we had the environmentalists globally. And what we've done is we've taken countries like Panama. Panama has the most incredible copper property in the world. You can get this copper. Number one, the copper relative to the surface of the earth is relatively high grade, relatively close to the surface of the earth. You can get it into the Pacific or the Atlantic Ocean in 5 minutes, Jim, right?
Mm.
This mine's been shut down for political reasons. This is one of the most pristine properties on the planet. Same thing in Peru, same thing in Chile. Global copper production, the amount of new copper mines that have come on because of environmental regulations and just political pressures, we are heading for a copper crisis in 2026, 27, 28, when all these data centers come on. Like you said, we've got 1 billion people in the global population more than 10 years ago, almost 1 billion for that relative. And you've got artificial intelligence coming on, and you've got Bitcoin. Bitcoin alone at close to 100,000 on Bitcoin, that the energy consumption globally for Bitcoin at 100,000 is equivalent to South Africa.
Mm.
So you've got India, you've got artificial intelligence, we've got the Ukraine rebuild, Jim, the Ukraine and Los Angeles. Just do a Google search for the amount of structures in the Ukraine and Los Angeles. This is a copper nightmare crisis of unprecedented. It's going to be like the OPEC oil crisis in the 70s, probably on that scale, but in copper. And it's all out there 26, 27, 28.
So when you look at this, and this is something that we've seen the IA consistently underestimate petroleum demand. And they keep talking about peak energy demand. By the end of this decade, we're not going to need this stuff, and they've been wrong consistently. And if you take a look at, as you talk about in your book, you just mentioned copper, energy. I mean, you think of copper and all the minerals that we need for the Green New Deal. What does it take? It takes mining. What does mining run on? It runs on diesel fuels, the loaders, the trucks, and everything else. And nobody is kind of thought this through. How are we going to do this if we're not allowing mines? I'm thinking of, I don't know if it's the Resolute mine in Arizona. That's been in the permit stage for over a decade.
Yes, yes. So we just did a call with Adrian Day. Adrian Day's been a big contributor in our book, and he's one of the top metals and mining strategists, research analysts in the world. And he's a big part of our book. And Adrian has a chart of he has a chart of like the last 4 decades. and the amount of major copper mines that come on. And in the last 4 decades, and you look at this decade that we're in now, these copper mines, they take a long time to bring them online. Billions and billions and billions of dollars of investment. And it's like turning around an aircraft carrier in the Pacific. When you have a problem like this, you need to get way out in front of it. And we're just way behind it. And I think right now look at the Trump team. They know. Look what they're trying to do in Greenland, right? Look what they're trying to do in the Ukraine. They know that China and Russia have completely outflanked the United States in rare earths, and these rare earth metals are going to be absolutely so important for robotics. Not just copper, but rare earths that go into all types of new technologies. We are literally a decade or two behind Russia and China.
Hmm.
And the White House is now, and many members of Congress are now waking up to this fact. And we talk about, it's a big part of the book. There's a whole chapter, half a chapter on rare earths and how far behind we are.
It's interesting because you talk about going back to Buffett for a minute. He's up to about $350 billion in cash. But at the same time, if you look at what he's been buying, he owns a significant portion of Occidental Petroleum. He's got a major investment in Chevron. He's been investing in energy. So he probably sees the same thing that we see and you see.
Yeah, if you look at his portfolio, he's sold down his Apple by 600 million shares, and he's redeploying that money into Oxy and Chevron. And Greg Abel and Buffett were on record Saturday, or in the annual meeting, and what they said was, listen, energy infrastructure, artificial intelligence, this is really the place to be. And I know that's where they're looking. You're going to see a big Buffett investment in this space, and they're looking at all kinds of energy infrastructure, whether it be natural gas, uranium, nuclear power. This is where they're focused, and it's the trade of the next decade, and copper as well.
I want to talk about the investment thesis in your book. Growth stocks do well in periods of low inflation or disinflation. On Wall Street, discounted cash flows, you're using a lower interest rate to come up with these valuations. Inflation changes this investment paradigm from growth to value and hard assets. Let's talk about where we need to be going, because your book here really is about a paradigm shift. And you're talking about what we are likely to see over the next decade or more, and how to position yourself.
So this gets back to the reaction function. Normally, when you move into a higher interest rate, higher inflation regime, that DCF model, discounted cash flow, analysts, it's all based on the risk-free rate, Jim. So the risk-free rate, if it's 1 or 2%, then you want to be in software companies, growth stocks that, if you think of like a software company, if you've got a cash flow for the next 10 years of $1 billion, right? Those cash flows are worth more in a lower interest rate regime, lower inflation regime. In other words, you have a software company, so you have $1 billion of cash flow over 10 years. If you're in a disinflationary world with low interest rates, those cash flows are worth more. But if you're in a higher interest rate regime with higher inflation, and same type of company, software company, $1 billion of cash flow over 10 years, oh, guess what? That $1 billion of cash flow is worth a lot less if your interest rates and inflation are higher. And so what happens is the portfolio construction on Wall Street migrates from growth stocks to value, companies that own assets in the ground, companies that like Berkshire's owning Occidental. And you can buy Occidental right now for what, 4 times EBITDA. They have assets in the ground that will protect you from inflation. And that the money should be migrating over, which it is, and you can see Buffett doing it. But because of this passive overdose, a lot of people are stuck in the S&P 500. And because of that passive representation, passive versus active, it's up near 60%. The action function from moving to growth to value is a little slower, much slower than it normally would be. Because in the old days, the market was full of Buffetts, right? active managers. Everybody was Buffett's not an active manager. Buffett's an active manager. Buffett's not a passive investor. He's an active. So he's choosing what to buy and sell. So we now have a market that has much, much, much fewer Warren Buffett types. It's all passive. And even though we've moved into a higher interest rates, higher inflation regime, that migration, that reaction function is slower because of so many trillions of dollars that are in passive indexes. But don't get me wrong, this migration is happening.
Larry, in your book, you talk about the decline of the U.S. dollar and also the end of the petrodollar. We're certainly seeing that in the Middle East right now. You've got Saudi Arabia that is selling oil denominated in yuan in some of the other Gulf states. And certainly, if we're seeing this as it is playing out now and more likely to get worse, you're going to need some kind of dollar hedge. And I keep thinking of precious metals, hard assets. So let's talk about a portfolio that works well in this paradigm shift that your book talks about.
Okay, so let's get back to what I talked about before, where if the world's reserve currency is starting to act somewhat more like an emerging market country in the sense that for the first time in the last month, we had a significant move down in stocks, down in bonds, and down in the dollar. So if you're a portfolio manager in Europe or Canada or Asia, you're really exposed to lower stocks, lower bonds, and lower dollars. So you're getting hit on all angles. This is something that has happened in Brazil to investors in Brazil and all different types of countries. At the same time, the point we make in the book is from a sanctions point of view, over the last 20 years, both Republicans and Democrats have hit emerging market countries over the head with the billy club that is either sanctions or confiscation of capital. And Russia, I'm sure whatever you want to say about the Ukraine, I'm sure you could say they deserved to have their capital confiscated. Unfortunately, you confiscated the capital, Washington, after and during a 10-year period of billy clubbing all these emerging market countries over the head with sanctions. So at the end of the day, it's the ultimate hubris. It's the ultimate ignorant hubris where the Washington, they're smoking in the dynamite shed. They're smoking with hubris, and that this overconfidence in the dollar. And so what we've done is we've jacked up deficits, right? We're tariffing, we're trying to pay for those deficits by taxing the world through aggressive trade talks. And that's all that is taxing other countries, trying to pay for our deficit. And we've sanctioned a lot of different emerging market countries, and so this whole thing is like 10 years of basically just beating up our wife, right? This is disgusting behavior. And that's what's happened. And now we're at the point where if you're a global investor, if you look, there's a chart that I posted on Twitter today, and it's getting a lot of attention. It's gold versus the GLD share count. And if you look at central banks globally, or if you're a government and you're trying to diversify away from dollars, you buy gold. But what's weird is the GLD share count is actually not following, and that's because central banks really don't buy the GLD. And so what we're seeing is, look at the Aussie dollar. There's really a portfolio of what is the altered dollar basket. In other words, right now, if you look at European investors, Asian investors, we're 2 standard deviations above, Jim, the 20 or 30-year norm. I'm not saying the dollar is going to lose its reserve currency status tomorrow, right? But we're 2 standard deviations above the 20, 30-year norm. People are like table max dollars. And if you're in a boardroom in Europe or in Asia, in a bank or a mutual company or not, any type of asset manager, there's, like I said, a gun to your head. You got to take down dollar exposure, because Biden just jacked up the deficit $1 trillion in 100 days on the way out. Trump's beating up all of our counterparties with tariff threats, and we've sanctioned emerging market countries, and we've confiscated capital from Russia for 10 years. So they're just driving money away from the dollar. So just watch the Canadian dollar. Look how strong that is relative to the trade drama. Look at the Aussie dollar. People are forming a basket of alternatives to the U.S. dollar. There's no question about it.
And in this transition, your last chapter, you talk about where to put money. You talk about hard assets, gold, silver, copper, cobalt, lithium, uranium, oil, natural gas, you name it. But, when the dollar is losing its value and we're in an inflationary environment, you've got to protect yourself in that environment.
Right. And you want to look at a portfolio that is positioned for the AI revolution, for this transition, the green meadow. We need that green meadow of nuclear power to get to carbon neutral 2050. We need that natural gas to get to carbon neutral 2100. And so it's a combination of a totally different portfolio construction that has more. In the old day, the 60-40 portfolio we talked about in the book is dead. We say that in the book. It was 60% stocks, 40% bonds. It's now 30-30-40. And so 30% commodities, 30% stocks, 40% bonds. And that's the new portfolio. And out of that stocks and commodities section, you're going to have a lot of copper, uranium, cobalt, your own companies that produce these key strategic metals. And these companies, I think 5 or 10 years from now, a Rio Tinto could be in the top of the S&P 500 in terms of ownership. A BHP could be at the top. Obviously, an Exxon or a Chevron had been there in the past. In the 70s or 80s, they were the number one size company in the S&P. We're probably heading back toward that kind of world.
It's amazing because we're 30% invested in commodities for this very reason. I want to throw out a final question. You mentioned the fourth turning. We're in the middle of that. Usually in a fourth turning, when you come out of it, the old institutions aren't there. They're replaced by new institutions, a new paradigm. If you were to look out 10 years from now, Larry, what do you think we look like coming out of all of this?
Well, we clearly are going to have 3 parties instead of 2 in the United States. That's the first, where we're going to have, much more, 3 to 4 or 5, maybe 5 different political parties. So that's the first, is where the establishment, Republicans and Democrats, have really hurt the base. And that's why there's the Trumps of the world, right? And so we're heading back toward a different type of world that way. We're heading toward a world where we don't have enough natural resources. We're going to have to massively rebuild the U.S. power grid. It's going to take $2 trillion bucks. The U.S. power grid's like a 90-year-old man. It's 30 years old in some spots, 40 years old in others. So the world is a much more. It's definitely robotics and artificial intelligence, but people forget. Just do a ChatGPT search. Just do some research. The amount of copper if you're going to take all these robots, millions of robots that are going to replace human beings, the amount of copper you need for that is just literally tons and tons of copper, right? That go into robotics, that go into artificial intelligence, that go into the power grid. This is the type of world that's coming at us.
Incredible. Well, I want to highly recommend to our listeners your book. As I mentioned, I bought this for my entire staff. When I picked it up, Larry, I started reading it. I couldn't put it down. And just, my kudos for writing something this profound. You were very prescient in predicting the subprime crisis, and I think this book predicts what's coming. So, well done, my friend.
Thanks, Jim. It was great to catch up.